Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So for today, we are sitting at $51,970.64. We are up in the green, 0.76% today. Then for that 1 week mark, we are up nearly $3,500 with a 7.2% return. 1 month mark, we're up nearly $2,300, a 4.6% return. 3 month mark, we're up $1,955, a 3.91% return. Then that 1 year mark, we're up $11,703.03, a 29.06% return. And then all time, we were up $26,349.89, a 102.79% return. Of course, it's going to change because the market is open. But the buying power currently is sitting at $36.11. Just going to let that sit, accrue a little bit of interest, and when the next dividend hits the account, that will just keep bumping up our income. First off, we've got Realty Income, ticker symbol O at 5410. Up 93 cents today. We have 5 shares, $270.51 is our market value. Average cost is $51.75. 0.52% of the portfolio is in Realty Income. Today we're up $4.68. Total we're up $11.78, a 4.56% return. Guys, this is one of those that I want to keep building. I want it back up to that 170 share count or even 200. I love the monthly income that it does provide. And I'm excited to get it back to the original position. Next up, we got Altria sitting at 51.20, 320 shares, $16K worth of market value. Average cost is right around $47.30. 31.5% of the portfolio is in Altria. Today we're up $48. Total we're up $1,255 and 8.3% return. Guys, I think the market has finally realized that jewels in the past and they do make more money year over year. They do have a massive dividend that has grown for over 50 years, so they reward shareholders while keeping their business healthy. I understand why they did the jewel investment, but I'm happy that it's in the past. All the write-offs are done. They've already taken their hit for that year or those 2 years, and just completely divested from it, and they're away from it now, and now they can focus on the future. So I'm excited to see where the stock goes from here. Then we've got Coca-Cola, another dividend king at $61.85, 15 shares, $927 worth of market value. Gonna take a sip of my Coca-Cola right now. Man, I love being a shareholder. Average cost is $60.54. 1.8% of the portfolio is in Coca-Cola. Today we are up $1.13. Total we're up right around $19.50, around $20 we're up, about 2.15%. So you guys, a good buying opportunity here for Coca-Cola. Yeah, it's a little bit above the average cost, but $1 is not going to, make or break me. So overall, I do think Coca-Cola is going to be one of the longest term holdings in the portfolio, but I get why people don't like it being in that position. And let me tell you why it is for me. Because even if the growth isn't spectacular, it's a company I want to own. It's a business I understand and that I love. And so even though let's say it grows 2% a year, that's fine. I feel like I have, Apple, Visa, and Google that will really be the main growth drivers of the portfolio anyway. It's just a company that I want to own long term. And I feel weird if it's not in the portfolio. I've owned it before and I sold it. And I should have just kept owning like the 60 shares that I had at that point. So, hindsight's 2020. It is one of my personal favorite businesses. Therefore, I want to own it. So. Then we got Apple at $230.58, down $7.36 today, or $7.30 today, down 3%. I know a lot of people probably freak out about that, but it's still not below my average cost, so I could really care less if the stock drops, 3, 4, 5% in a day. If anything, it's a good thing for me. But we've got 10 shares, $2,300 of market value. Average cost is $218.89, so right around $220 a share. 4.4% of the portfolio is in Apple. Today we're down around $75, a 3% loss, but total we're up $115, 5.3% gain. Guys, I want to be buying a share, at least a share or two a month of Apple. That's going to be the goal for the portfolio, is at least a share. So by the end of the year, I want to be sitting at like 22 shares at least, if not like 25 to 30. Also, I have a goal of I want to buy a few shares of Realty Income if I can a month too. So we'll see how that goes. But the main goal for this year is to purchase more Apple stock. So hopefully by December of this year, we're sitting at least 20 shares. Then we got AbbVie at 172.99, 95 shares, 16K worth of market value. Average cost is $95.19. 31% of the portfolio is in AbbVie, so about the same amount that we have in Altria. $156. We're up about 1% today. Total, we're up $7,300 with an 81% return. And a dividend coming in on February 14th of $155.80. I think the first dividend that I got from them was around $75 to $80. So we've nearly doubled our dividend income. And of course, I've added shares, and the dividend has gone out considerably. I believe it's $1.55 now, and it was $1.07 when I first purchased it. So, about 35-cent gain over the course of 5 years, which is nice, considering that I've been getting that pay raise of like 2 to 3% every single year for doing nothing, and the stock appreciation's been just insane on top of that. So overall, it's been the best investment that I've ever made, and I plan on holding it for the long term. As in, the only time that I would sell a company is if they cut the dividend, and it wasn't because, like, if it makes sense to cut a dividend and I still believe in the company, I will hold it long term. But most of the time, if it's just like, oh, we made a bad business decision, etc. Like if Altria needed to cut the dividend for the write-offs of Jewel, that would make sense to me, because they made a bad. They thought they were going to make money. The regulation, something they couldn't foresee, made it so that business operation was no longer operable or profitable for them. So it makes sense that they would divest a little bit and say like, hey, we're going to have to lower the dividend to like 87 cents this year, but it'll come back to normal rates once Jewel's spun out or debunked or whatever. That would make sense to me. So that I probably wouldn't sell for. But just cutting it because you're bad at like managing your money is different than trying to like future-proof your business and it not going well. Like an Intel right now is just they're way underwater. So there's a difference between there's a little bit of a gray area depending on whether or not I would cut the dividend. Or excuse me, cut a position because of a dividend cut. And with AbbVie, I don't see that happening in the foreseeable future. The profitability is great. It's done what I thought it was going to do. And I'll quote Charlie Munger here. He said in one of the Berkshire meetings, he said, there's something beautiful about predicting the future with companies, because if you pick the wrong ones, you have to buy and sell, and then you have to pay taxes on that. And, your gains are lower because you bought and had to buy and sell. When you have a quality company and you can properly predict the future, it's such a beautiful thing to just be able to sit on your ass. So that's what I'm trying to do, is just I did the analysis, right? Like 5 years ago. It's panned out better than what I thought it was going to, especially when you add dividend growth on top of that. Just going to sit on my ass and let it grow, right? There's no reason to take it out unless something fundamentally changes with the business. And until then, I'm just going to let it run. That's the same thing that Buffett did with like American Express and Coca-Cola. He's owned those stocks for, 50, 60 plus years at this point. So there's no reason to sell it unless something fundamentally changes with the business. And until that does, I'm just going to let it sit and print me more beautiful money. Then, of course, we got Visa. Now, this is one of my personal favorites, up there with Coca-Cola and Apple. Sitting at $317.81, up $1.53 today. Have one share, so the market value, of course, reflects the single position, the price of the stock. Average cost is around $270 a share. 0.61% of the portfolio is in Visa. Today we're up $1.55. Total, we're up nearly $50 with an 18% return. Now, guys, this is one of those that it's in the same position as AbbVie for me. It's above my average cost to a point where I don't want to buy anymore. I have to wait for it to drop. Visa rarely drops. So it's one of those that like I should have bought more when I had the chance. Hindsight's 20/20 kind of thing. But I don't want to sell the single share because I still want to own it. but eventually when it drops below, like, if it ever gets down to like 260, 270, I'm purchasing more. But for now, I'm happy to just let it keep growing. But this eventually, this is going to be one of those, I think, unlike Apple, where I like bought it and then can kind of keep buying it, because it's not, the price isn't like astronomically higher than my average cost, like it would be with AbbVie. This is one of those that I'm going to have like let's say I want a certain position size. Like, I'm not going to do the math on top of my head, but just say like I wanted 50 shares. I will need $15,000 set aside to specifically buy Visa at like $300 a share, right? So this is one of those that it's like, it's not going, like, it might fall a little bit, but most of the time it goes up, like just historically. Like if you look at the year to date is short. That's short because it's only been a month, but it's up 20% the past year. 5 years, it's up 63%. So over the course of just like, even in short increments, it's relatively up, you know? With this one, it's going to have to be like a batch buy. Like, it's going to be like there's a scandal, or, you know, maybe honestly, with Visa, I think the biggest red flag is going to be legislation, is going to be like the government coming in and saying, hey, you're a monopoly, like they did with Google, and try to take something and make them spin something out of the business. And with those headlines and with investor sentiment being bad, people will sell out of it because they think that, you know, it's always doom and gloom when something like that happens. But Visa is a very good business. So, I mean, if something like that happened and it tanked, I would want to have like a $10,000 stockpile, which, I mean, honestly, at these prices, like $10,000 is going to get me like, what, 30? Yeah, like 30 shares of it. So it's like, even if you put it in that context, like $10,000 is only going to buy me 30 shares of Visa. Like 29, and I'll have 30 shares total, which is not bad, right? That's still not a bad. That's still like $70 in dividend income, and I get 30 shares of a quality company. But this is one of those that I feel like I'm just going to have to be extremely patient. I mean, if I can sit and wait for AbbVie to drop back down to my average cost for 5 years, I think I can wait on Visa. But this is one of those that, like, you have to be really patient and have money on the side, like in your account, specifically just for Visa stock. Transfer it over, close the account, $15K in Visa. That's gonna be the move. It's like, it's gonna have to be like a really big chunk of money that just gets put into the stock market and bought right away when it's at a low price. And I'm willing to wait for that. I think Visa's worth it. Then, of course, we got Walgreens sitting at $12.80. Switched it out for T. Rowe Price. I have 1,200 shares at $15,366. Average cost is $9.73. Around 30% of the portfolio is in Walgreens. Today, we're up $336. Total, we are up $3,700, a 31% return. Guys, this was near a 52-week low. I switched it out for T. Rowe Price, and literally in the past, like, 10 days, since last Monday, it's Thursday today, we've made almost $3,700, like a 31% return. That's a better return than I've had owning T. Rowe Price for, like, a year or two. So, like, it just proves that, yes, I love T. Rowe Price. Eventually, like, the long-term goal for Walgreens, if let's say Walgreens goes and it hits like 30K or 25K, whatever, say it doubles from here. If I can put the same amount of money in T. Rowe Price at the Walgreens price for the stock was double the dividend income, right? More than, because it was $125 to $300. Now, let's say this goes to like $25,000 to $30,000, then the opportunity cost flips, because Walgreens has gone up would have gone up significantly by then. So then there's more downside than upside of the stock, and the dividend would still only be $300. Now, $300 is a lot of money to get in passive income, but at around the price I had for T. Rowe, I'd actually make $340, not just $300. So it's interesting, because one of the big things in investing is it's important to have your goals for a stock or company, right? It's important to know where you want your ins and outs to be. Like, I want to get in Walgreens at $9.70 and I want to get out at $25. Now, if it never hits $25, cool, I will just sit and get that $300 dividend. If it hits $25 a share, I'm selling it immediately when it hits 25. I'll have a stop loss order or a stop order at 25 to sell out the whole position. And then once that happens, I will buy T. Rowe Price at say like 110, 300, get 272 shares and make $340 a month. So it'll be a complete flip. Now, my long-term goal, like let's say if I could pick what stock I wanted, I would put like say 15K into like, if I could get Visa at around the same price, which is, I don't think that of course will happen, with around the same dividend, like it would have to drop astronomically for it to be even close to what Walgreens is paying me right now. But if there's a way that I could get the dividend income from either like Walgreens or better, like what would happen with T. Rowe Price, if Walgreens stock doubled and I put it back into T. Rowe and made $340, I don't want to put the money into T. Rowe Price into Visa because my dividend income will go down drastically. It only pays like 56 cents a share, right? Which is great. I still love Visa, right? But if I'm going by just the quality of the company, for my 3, 6, 9, 12 month, I want both Google and Visa. That's it, right? I don't mind owning T. Rowe. Like I love the company. I've done extensive research. It's been kind of flat for the past few years, which is totally fine, because that means if it gets lower than my average cost or around my average cost, I just buy more, which is what I've been doing. But like in the perfect scenario, I flip Walgreens, put it back into T. Rowe. I wait for either Google or Visa to get to a point, which keep in mind, Google would have to go down to like $12 a share or something, and like Visa would have to go down to like $100 a share for it to, or like I think it'd have to go down to like 40 something for me to get the same amount of dividend income. So it's just not really possible. But in a perfect scenario, if I could get like, let's say this turns to 30K and then it goes to like 50 or 60K in T. Rowe, because T. Rowe's at a price right around the price right where at the 52-week high it's got $100 upside. So $30,000 would turn into 300, and then I'd put it into something like Visa, where I think the overall business is better. So if it was something like that, if I could like flip Walgreens and then again go in and flip T. Rowe, my end goal would be to put it into either Google or Visa to get around the same, like $300 every single month in that high quality company. But it just takes, the problem with that strategy though is it would take so much money, because Google pays 20 cents and Visa pays around like 50 something cents, right? So it takes a lot more capital to get the same amount of dividend, but they are higher quality companies. So that's like my main goal. Is I like Walgreens. I like that the company's moving up. I like that the trajectory's going up. They switched CEOs, and I like that they're really focusing on their pharmacy and being like, that's their core business. And it's kind of like what happened with AT&T with Warner Brothers Discovery. Now they're back to just being telecom, doing what they do best. I like that Walgreens is refocusing the business. And I want to write it up, right? And I do like Walgreens. I think that with the CEO switch, there's a lot of optimism, and they could really do a good job. I've heard rumors that they might get sold. Great. They can buy me out. So either way, right? The long-term is, the long-term thesis for Walgreens is I'm going to sell it near the top, which would be like what, 25, I think, for the last, like 24, $25 a share. So double or more than double my price, right? So I'll put in 11, I'll get out with 22 to 25, if not around 30 at this price. So I have about 30. Put the 30 in T. Rowe. T. Rowe will go up, be sideways, whatever, and eventually put that money into Visa, and then Google as well. So that's my long term. I do like I said, I like both businesses, but I do recognize the quality that Google and Visa, how good of a quality company those both are, and those, I think, come with a premium. So my goal as an investor is to analyze and try to get it when I feel like that quality, or that like, I don't know, that like exclusivity of being a high-tech company, or like a highly profitable company with a great track record, like all that's baked into the stock. I want to buy it when that's like COVID levels for the airlines and cruise ship companies. that's when I want to buy, but it takes a while. So I'm going to be patient. We'll see how Walgreens does. You know, if it gets to 24 to 25K, then I'll put it back into T Rowe. I'll sit pretty with T Rowe Price, making more money with the dividend every month. And eventually, when, you know, between me putting money on the sidelines and the money that's within T Rowe Price or what, you know, whatever company I own at that point, I would assume I put Walgreens into T Rowe and then T Rowe into Visa. But we'll see how that goes. But over the long term, guys, my goal is to have both Visa and Google in the top 5. And I'm going to have to, you know, get there slowly, but we'll get there. For Walgreens, I'm waiting for it to hit 25 a share. I'll sell out of it, put it into T Rowe, wait for T Rowe to go back up to like 200-ish, and then put that money into Visa. And then, guys, of course, the watch list. I want to buy Google anywhere under, like, I think it's like 200. So, like, I'm okay with, like, initiating a price at 195 and just buying it below that. But, of course, guys, you know, Google owns Google Search, Google AdSense. Of course, YouTube is the main thing I'm buying it for. And then Berkshire Hathaway, I like how the company is run. I like I like how well they manage their money. They're ready for a big downturn, whether one happens or not. They've insulated the business to be able to weather pretty much any storm when it comes to insurance or just the economy in general, and that is exactly what you'd want a CEO to do. Buffett right now is getting ready to fortify his legacy, making Berkshire an impenetrable fortress that can withstand any hurricane or economic downturn, whatever, anything. He's getting ready to both make sure the business is unconquerable and being ready for a huge buy. I'm surprised he's been selling Apple, but at the current prices, I get it. I'm buying it at these prices, though. But for him, the prices are what I have on AbbVie, essentially. But, you know, overall, guys, I think this is one of the best and wisest run companies in the entire world. So I definitely want some Berkshire Hathaway stock. With that being said, guys, thank you so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. Hit the like button so more people see this video. And I will see you guys tomorrow, Payday Friday, with another Robinhood portfolio update. Take care, guys.